As we head into the summer season with indices posting continuous historical highs, this as investors get set to go off on holiday. The question is, will this current bullish run also take a siesta? Well, Ben Kumar of 7 Investment Management joins me now for the answer. Hello to you, Ben. Thank you very much indeed for joining us today. As I was saying, we've witnessed impressive returns for the calendar year, but if we look at the history books over the last 20 years or so, it seems like indices do tend to run out of steam at this time of the year. Do you think that this will happen this year?
Well, I think they get knocked around a bit more by events in the summer, and lots of people say there's low liquidity, and that as you say, people are on holiday and therefore maybe don't react to decisions, or junior people on the desks is something we hear a lot at big banks. Are in charge of trading strategies. I think we are in a situation this summer where there are a lot of political events that could potentially, surprise markets. When you've got confidence kind of as high as it's been for some time, and you've got the equity markets at these kind of historically quite high valuations, it doesn't take much for there to be a little wobble. We saw it in the tech stock fall, a couple of weeks ago. It doesn't take much for a 5% fall to just happen on one day.
We've got Brexit negotiations, we've got a German election on the horizon, we've got threats of a Trump impeachment. What do you think are the biggest risks going forward in terms of these political events?
Well, I think it is the potential overreaction from markets. There is this tendency to be surprised when it comes to, something that Donald Trump says, or a potential disruption in Europe. Greece has reared its head most summers for the past 5 years, and things have been very quiet. The loan negotiations going well. When events do happen, people are maybe just a little bit complacent, get surprised, and then panic.
What happens if people do panic then? Because as I say, there's lots going on this summer. What's that going to do?
Well, I think the issue we've had recently is that lots of people have seen this bull market run and run and run, and everyone has basically reluctantly capitulated and started investing in risk assets. The problem is, though, that everyone is very near the door. It's really tentative. People are investing in high-yield bonds, but they're ready to pull back. They're investing in equities, but they're ready to pull back. People are nervously dipping a toe in. I think that the danger is that, you see one person rush for the door and everyone else follows. We know that the machine trading algorithms tend to exacerbate movements one way or the other. People can be panicked very, very easily.
Do you think it's better then, in terms of strategy this summer, do you think it is better just to jet off somewhere and forget about trading, or do you think that there's plenty of opportunities to be had?
I suspect there'll be a good few opportunities to kind of maybe buy on surprise dips. But if you have a slightly longer term view on things, I think the kind of either leave your longs in place or go to cash and jet off for a while is a pretty reasonable thing. I don't think you're going to miss out on anything other than perhaps volatility. But
volatility is opportunist, isn't it?
Yeah, absolutely right. We see every time for the past 3 years that the US market in particular, any time it's dipped by 5% has been a perfect time to buy, and you've made your money back very quickly. I think that may well continue, but the chances are that at some point or another, that 5% dip is going to turn into a 10 or 20% dip. I don't think it's necessarily this summer, but risks are probably higher than they've been in a long while that there could be an event that causes it.
Ben, thank you very much indeed. I appreciate your time today. That's Ben Kumar there of 7 Investment. Thank you very much.